It's another monster upside inflation surprise from New York City this morning. Good morning, good morning. Yields up, equities lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York, we begin with the big issue, a whole lot more fuel for the Fed.
They're going to go to 75.
Definitely 75, I think, is in the cards.
We're going to see 75 basis points.
It all comes back to this inflation story.
The Fed is really in a sticky spot right now.
This Fed isn't stopping.
Right now, they are almost solely focused on the inflation mandate.
And unfortunately, it's a crude channel of, lowering demand.
You have an overheating economy.
Employment is still quite strong out there.
We got a June jobs report, which was pretty solid.
Wage growth is still really, really strong in America. And so is inflation expectations.
75 is almost assuredly baked in for the July meeting.
Maybe the elusive peak of inflation is upon us today.
Right now, it all points in the direction of, maybe they're leaning towards a 75 basis point hike.
Or maybe more. Joining us now is TD's Priya Misra, JPMorgan's David Kelly. Priya, first to you. Your reaction to this one?
I think this keeps pressure on the Fed to keep going. I mean, we still think they go 75 in July. They reach neutral. I think what the market had been doing was taking down that terminal rate significantly. We're priced for 4% after the June Fed meeting. It was as low as 3.25% just a week ago. That pressure, I think those rates keep rising. We think they can slow down the pace, but I don't think they're anywhere close to stopping. I mean, they're unconditionally focused on inflation. Inflation's keeping pressure on them. So I think the inversion in the curve continues. The Fed keeps hiking until they clearly see a big sign of slowdown. There's no slowdown in inflation here. So I think this is a really tough backdrop for risk assets and for the Fed. They can't respond to slowing growth. We know growth is slowing, but I think they're going to just keep going. And that's why that front end of the Treasury curve, I think, stays high because the market has to price in the Fed getting to 375 or 4. The long end is where I see value because I think growth is now slowing and the Fed is not going to be able to help much.
David Kelly, your thoughts?
Well, this is a really unusual economy, and I hope the Federal Reserve recognizes that. This was a very hot report, but I think this is the last hot month in an inflation heat wave. I think the numbers you see for July are going to come in at pretty much zero on a month-over-month increase in inflation. I think that'll be the same in August. If you look at a lot of the daily and weekly indicators on inflation components, they all turned in the early to mid part of June. So they peaked at very high levels, but they've been coming down very rapidly. As one example, gasoline prices were $5.01 a month ago. They're now $4.63. I think this is going on generally. So I agree that the Fed probably will go 75 basis points, but I think they really ought to be careful here because this is actually turning. It just hasn't turned in the month of June.
David, is it turning in the right places? Rents were up another 0.8% in May, the largest monthly advance since 1986. I understand we might come down from 9, perhaps to 8, 7, 6, 5. David, where do you think this one settles out?
Well, you're right. I mean, the problem is that the way rents, you wouldn't think rents are that important in inflation, but unfortunately they feed through to a very technical construct called owner's equivalent rent, which is about a third of core CPI. And so the Federal Reserve pays a lot of attention to that. But for most people, if they don't rent, it's not a big deal if rents have gone up. Yes, rents tend to lag and they're still going up. But we see a lot of signs of weakening demand. For example, airline fares, they peaked in late May, really, and they've been coming down. I think they'll come down very substantially for July. So there are sticky parts of inflation. Rents are one of them, which I think will keep core inflation relatively hot for a little while here. But headline is going to begin to back off here because energy is going to turn very sharply in the month of July.
Let's get to Mike McKee for a little bit more. Morning, Mike.
Good morning, John. Well, it is the headline that the Biden administration feared, 9.1% in terms of the year-over-year rise in inflation. And most of that is going to be coming from gasoline, of course, which was up significantly during the month. 9.1%, is that the peak? That's going to be the question. We did see a bit of a drop in the year-over-year core rate, but gasoline 11.2%. That puts it up 59.9% on the year. And that's the number that most people look at, is what they cost to fill their tank. Food at home, still high, although it's flattened out. And as David was just talking about, owner's equivalent rent up 0.7. It takes a while for that to come down because people don't sell houses every day. And while the number may not matter to people who don't rent all that much, or who aren't buying a house right now, it does go into the headline and core numbers and contributes to the Fed's problems. Used cars were supposed to go down. They didn't. And apparel, people thought that might go down because of bloated inventories. It didn't. So a problem overall for the Fed. But it's that gasoline price that really bothers people. And on a year-over-year basis, people are spending more money, more of their paycheck each month on gasoline than they have in about 8 years. That's what gets noticed. So the president's trip to the Middle East could be very important politically for him, because here's the last problem for the president. The level of real average hourly earnings, which is inflation adjusted, is down by 3.3% to a new low. So people's average hourly earnings adjusted for inflation are falling farther and farther behind where the inflation level is.
It's a big problem. Mike McKee, thank you. I feel like we've spent the last 3 months looking for this mechanical peak in year-over-year CPI, and here we are talking about a 9 handle. Shout out to Mohammed Al-Arian, who nailed this on this program over a month ago, who basically came out and said, I do not think that is the mechanical peak. I think we could see 9. We've got 9. Going through some of these numbers, gas prices up 11.2% in June from a month earlier. A lot of people looking for that to come back. David Kelly talked about that a couple of minutes ago. This is what we see in rent, up 0.8% from May, the most since 1986. In food costs up 1% and 10.4% from a month and from a year ago, the largest increase since 1981. I'm looking at this, Priya. Yes, there are reasons to believe that this could be the last really bad one. But Priya, I want to understand when I'm going to see the next good one. How long do I have to wait for that?
I think you have to wait a while. I'm actually not that convinced that shelter has peaked, because when we model up rent inflation or OER, it tends to be a really lagged response to home prices. Home prices have been, the housing market's on fire, or has been for the last 2 years. So we actually have shelter continuing to rise on a year-over-year basis, only peaking early next year. That's a huge part of core CPI. So I think headline can start to come off. But as you said, if we go from 9 to 7, the Fed is not going to be able to slow down a whole. I think they can slow down the pace. I think once we reach neutral, they don't have to do these supersized 75 basis points. We're still talking 50 basis points. And now you're in clear restrictive territory with QT going. So when you talk about a good report, I think we're looking at 4 or 5% for them to at least stop hiking. I mean, I struggle with the cuts being priced in. How can the Fed start to cut rates? Even if growth is slowing, if inflation is at 5, I think that's way too high. I don't think they can let inflation credibility go down any further. I think they're already struggling a little bit with inflation credibility. So your good report, I think we're looking at really the middle of next year when you start to see month-over-month prints. And I think they're going to focus much more on month-over-month prints, 0.2, 0.3. But we really need that shelter component to go down. And I don't think that's happening for the next 6 months.
Priya, you're short the 2-year. You doubled down on that in the last week. We're at 320 right now. Let's round this one up from 319, up 14 basis points on the day. We're at 4% on Fed funds. How much upside do you think is left on that 2-year?
So not a lot. I think the risk reward is just not that attractive. I mean, I'm looking at the market pricing in a terminal rate close to 4% as near the peak, because we know growth is slowing. We know the consumer is going to deal with lower savings, and that's going to start to impact growth. Now, what I struggled with when we doubled down was the market pricing in these cuts right after the terminal was reached. So I think those cuts can get priced out, but I think we can be pricing in a lot more cuts later in the year, later in the year next year. So I actually think the long end, like 5s, 10s, 30s, we're long 30-year real rates, as that is the best place. That's the place you hide out, because the Fed will unfortunately have to take rates into really restrictive territory, then keep it there for a while so they won't be able to ease. And then when inflation gives them that green signal, they may have to ease a lot more than just getting to neutral. And so I think that long end is attractive. But I think the front end, I don't love being short here. But the market's so volatile, we may get a chance again, 1 week growth print. And I think the the market's going to move. We're shifting from a narrative of high inflation, slow growth on a daily basis. So you could get that chance again in the next few days. But right now, I don't like being short twos.
Priya, just quickly, 2s10s, -15. What's the downside there?
Oh, I think it can flatten a lot more because, see, here's the thing. The market's pricing in a few cuts. But if we're really slowing down, whenever they do start to cut rates, I think they could go much below neutral. So, I think -50 is in our forecast, but I don't have a lot of conviction that it needs to stop at -50.
Wow.
It's really going to come down to when the Fed will have to take a choice. I mean, right now they're telling us unconditional commitment to inflation. It's a little easy for them to say it now because growth is okay. Will they be able to be as unconditional when the unemployment rate is a percentage point higher? So, I think that's what will floor how inverted the curve will get. But you need to see the labor market slow down for the Fed to move from that unconditional to we have a dual mandate. And I think that's still some ways off.
David, I wanted to get you back in here. There's something you said in your notes ahead of this appearance that jumped off the page to me. And I want to ask you this question. Is it a mistake to infer broad strength from the data we're seeing in the labour market right now?
Absolutely, because we came out of this pandemic with a real shortage of labour supply for lots of demographic reasons, immigration reasons. So you ended up with this huge excess demand for labour, which is generating this payroll growth. But meanwhile, at the end of this month, according to the Atlanta Fed, they believe we'll print a negative GDP report for the second consecutive quarter. Now, I'm not quite there, but this strong CPI report for June will bring down real retail sales, real consumer spending for June. So that gets me closer. I do think that GDP overall will have shrunk in the first half of 2022, which will fit a traditional definition of two consecutive quarters giving you a recession. So I think we're much weaker than the employment report tells you. And it's just an artifact of this weird labor market through the pandemic that gives you these payroll job gains. But there's a lot of weakness and there's a lot of pain out there. When you look at those higher food prices, higher gasoline prices, that's why consumer confidence is at a 50-year low. So I think there's a lot of weakness there. And the Federal Reserve just needs to recognize we're going to go through a cycle here. We're going through a cycle on employment, go through a cycle on inflation. But it's stupid to push rates up to 3.5%, 4%. in the knowledge that you're going to have to cut them next year, and you're basically just setting up an artificial cycle. And history suggests the Federal Reserve is not good at micromanaging the economy in this way. So they shouldn't go too far now because they're just going to have to reverse themselves in 2023.
David, you've just said what they shouldn't do. Is that different to what you expect they will do?
Yes, I think they'll go 75 basis points and they'll put out a lot of hardline rhetoric about raising rates. The dollar is already at almost a 40-year high in real terms. That's going to hurt our exports. It's going to hurt the housing market. But I think they're scared of looking weak on inflation. And unfortunately, this report is going to just give fuel to the hawkishness of their commentary. But I remember a time when central banks used to be forward-looking. They recognize that monetary policy works the lags, that inflation is a lagging economic indicator. So you should set policy for where the economy is going to be, not where the economy is right now. But that doesn't seem to be the doctrine of this Federal Reserve or the last one for that matter. So they're going to react to hot inflation today by being very aggressive later on this month.
They're committed to being late. David Kelly, Priya Misra, going to stick with us. David mentioned the dollar story. Euro-dollar, a clean break of parity briefly for the first time since 2002. Lots to talk about in the bond market. We talked about it briefly there. Yields up by 12 basis points on a 2-year to 317, and the equity market futures down by 1.2%. And a big call from Mike Gapen of Bank of America, who said this earlier this morning. We now forecast a mild recession in the US economy this year, a moderate downturn this year and below trend growth for much of next year, pushing the unemployment rate from 3.6% to 4.6%. That's the latest call from BofA. We're going to catch up with Michael Gapen in about 20 minutes' time. Around the opening bell. Looking forward to doing that. Haven't spoken to Mike for a while. Equities down then. Let's get you some movers. We can do that ahead of the opening bell with Abby.
Hey, John. Well, with the sharp leg lower this morning on the hot CPI print, big tech, which had been higher ahead of that report, now sharply lower. Microsoft is down 1.6%. This, of course, as yields are higher, so once again brings into question valuation. Amazon, same deal, second day of Prime Day, but nonetheless, the stock has reversed lower, down nearly 2%. Twitter, on the other hand, up 1.6%. This as Twitter has started litigation against Elon Musk, trying to force the billionaire to keep good on the $44 billion buyout. I'm sure that there's much more to come there. And as you've been pointing out, very far from that $54.20 buyout price. Delta Airlines down 6%, giving back yesterday's big gains. They missed profits for the second quarter. They're saying that it's very difficult to manage rising costs. A complete opposite to what American Airlines said yesterday in terms of maintaining the guidance and talking about a big rebound for the second quarter. So it's going to be interesting to see how it plays out among the various airlines, John.
Abby, thank you. A lot to talk about, including the President of the United States. In the next segment, we'll catch up with Anne-Marie Horden shortly after the President touched down in Tel Aviv, Israel. This is not the main focus of this trip for this market. We'll be looking to Friday when he sits down with the Crown Prince Mohammed bin Salman of Saudi Arabia, with a market staring at surging energy prices through June, and perhaps that story fades this month in July. That conversation next. From New York, this is Bloomberg.
We are suffering from inflation imposed as a consequence of what's going on in Ukraine. I'm not suggesting they're not problems, they're real problems, but they are solvable. China is not only not going to be the factory of the world, you're in the factory of the world, the United States.
That was President Biden yesterday. Today, kicking off his trip in the Middle East, heading to Jerusalem later this morning before heading to Saudi Arabia Thursday for a meeting with the Crown Prince on Friday. The National Security Advisor Jake Sullivan telling reporters the following. After the President has the opportunity to engage with the Saudi leadership, he will be able to demonstrate material progress. AMH joins us right now on the ground in Jerusalem. Anne-Marie, let's get to the end of this week. What's going to be the outcome?
Right. Well, really, Jonathan, this trip is all about getting more oil from the Middle East. And these inflation numbers today clearly paints that picture. The CPI energy index in the United States of America is up 42% over the past 12 months. This president is dealing with higher inflation. This comes up in polls after polls, and it's food, it's rent, and most notably, and what Americans see every single day, it's higher gasoline prices. He had a campaign promise to make the Kingdom of Saudi Arabia a pariah, but now he is dealing with this domestic issue, and so he's going to be stepping foot in the kingdom, flying the first president ever from Israel to Jeddah on Friday, and he'll be meeting with Crown Prince Mohammed bin Salman in a bid to try to ease some of this pain for U.S. consumers.
Where does the Crown Prince find the spare capacity in Saudi right now when they're already falling short of their output targets? Where does it come from?
Well, it's only going to be from Saudi Arabia or the United Arab Emirates. OPEC Plus, a number of countries, Angola, Libya, Nigeria, are not hitting their targets. So what this administration would like to see is that the group as a whole start to hit some of these targets. Halima Croft said potentially you could have the kingdom or the Emiratis step in and be able to fill some of that gap. But Jonathan, you know very well, this is only one part of the president's problem. The other, when it comes to the oil market, is spare capacity when it comes to refining capacity. A lot of that was shut down during the pandemic, and the place where he could tap into that would be China. Right now, China is about 40% of their spare capacity for refining capacity. That is products like gasoline, diesel, jet fuel. So this is only one part of the president's issue right now, and potentially it's just not enough before those November elections.
AMH, thank you. We'll catch up with Anne-Marie, doing great coverage for us on the ground in Jerusalem and then on to Saudi Arabia later this week. We'll catch up with AMH tomorrow. If you're just tuning in, big upside surprise, a 9-handle on headline CPI. Equities rolling over by 1.4%. A final word now with Priya Misra and David Kelly. Priya, first to you. I have to ask this question because I know many people are asking it. 75. Could that become 100? 100 basis point hike month end by this Fed?
It's a fair question. I mean, the Fed is very nimble and they're unconditionally focused on inflation. But we think they go 75. I mean, Chair Powell told us 50 or 75 at the last meeting. You know, I think if they go 100 without any warning, and we've got a couple of days before they go on blackout, so maybe the message changes. But I think 75 gets them to neutral. And I think it's September that's really interesting. The market's pricing in a little higher chance of 50. They can say September is about 50 or 75. Move that talk of terminal rate higher. I think if they go 100, is 100 the new normal pace of hikes? So I think it might be too market disruptive to go 100. So we're looking for 75 in July. But even though we've got a 50 in September, if the inflation numbers show no sign of peaking, I think then they can go 75 in September. So we're holding strong. I think they can't keep giving us forward guidance and then not following through. So we do think they'll go 75.
David, I wanted to give you the last word. If we get 75 at this meeting month end, how much confidence do you have that that is the final 75 basis point hike of this cycle?
I think there's a good chance of that because by the time they meet in September, they'll have 2 weak GDP reports in hand. I think they'll have a weak July and a weak August CPI report in hand. And at that point, they're going to be able to say, look, inflation has clearly moderated here from very high levels or is beginning to moderate and growth is clearly slow. So we're going to take it easy. So I think 75, yes, is going to happen at the end of this month. But I think they'll have plenty of reason to back off a bit at the September meeting. And I don't think this economy is going to give them further excuse to raise at a 75 basis point pace in any meeting for the rest of this year.
David, awesome to catch up, to get your opinion on things. David Kelly there of JPMorgan, Priya Misra of TD. Your equity market lower by 1.5% on the S&P, lower, of course, on the Nasdaq 100 off the back of what's happening in the bond market, with yields higher at the front end by 14 or 15 basis points off the back of what we saw on CPI in America about an hour ago, a 9-handle on headline inflation and a big upside surprise on core inflation in America, month over month too. Coming up, we'll get you some morning calls. Then later, I wanted to bring you this call. It's Michael Gapen of Bank of America looking for a recession in America this year. That conversation around the opening bell, not too far away. From New York, this is Bloomberg. Inflation coming in above every single economist's forecast, guesstimate. Call it what you will. Equities down 1.5% on the S&P, down 2% on the Nasdaq. That's the price action. Here are your morning calls. First up, KeyBank downgrading Caesars to sector weight, recommending investors reduce exposure to gaming stocks amid weaker global economic data. Next up, Deutsche Bank downgrading the gap to neutral, 292 price target, expecting the highly promotional environment to weigh on the retailer's profits. And finally, Citigroup cutting its Apple price target down to 175, citing concerns about a weakening consumer and continuing supply chain disruptions. That stock down by 1.9%. Up next, Bank of America's Michael Gapen, now seeing a mild recession in America this year, while UBS's Evan Brown says a soft landing is still achievable. Those conversations in the back half of this program. Your opening bell up next. I've said again, it is the wrong kind of upside surprise on inflation in America once again, and this is what it means for this equity market. Down by 1.5% on the S&P, on the Nasdaq down by 2 percentage points, on the Russell, on the small caps down by 1.4. That's the opening bell. Some fascinating moves in the bond market. Yields higher at the front end, looking for another big move from the Federal Reserve. That looks solidified. I'll get my words out. Yields up by 6 basis points on the 10-year to 3.0337%. In the FX market, a clean break of parity briefly. Euro dollar weaker by 0.1%. The euro weaker against the dollar. Crude 95.96. Big move lower yesterday, up 0.1% today. Let's get you some movers. Equities gapping lower, yields gapping higher. With your movers, here's Abby.
Hey, John. Well, yeah, it's a really brutal start here for stocks. At S&P 500 back below its 20-day moving average, telling that the near-term dip buyers, they are out. And it has a lot to do with big tech. As you know, Apple down 2.2% at this point, down 2.1% moments ago. This as yields surge higher, as you were mentioning. Of course, that puts valuation into question. Tesla down 2.7%. That could have something to do with the Twitter lawsuit against Elon Musk, but also that tech piece of Tesla coming under pressure. Chevron down 0.8%. Oil plunging yesterday and the day before. Today down slightly, but still, there's really nowhere to hide. I'm looking at the IMAP right now in the Bloomberg terminal, and all the sectors are lower, and that, of course, includes the bank. So even yields higher ahead of earnings tomorrow, investors very, very nervous. And if we take a quick look at the NASDAQ 100 futures, we are going to see that big move lower into that hot hot CPI print, John. Stocks had been higher, but a massive leg lower as investors get nervous about what's ahead relative to the Fed raising rates.
Abby, thank you. Going into earnings, and Abby nailed it. You look at the banks, they can't get a bid when yields are down, and they can't seem to make it happen when yields are up 12 basis points today on a 2-year to 317. Your equity market breakdown, information technology down by 1.75%, consumer discretionary down by 1.9. Tech in focus. Let's get to Ed Ludlow for a little bit more. Morning, Ed.
Yeah, good morning, John. Looking at the NASDAQ 100 and the biggest points movers to the downside, it's names like Apple, Amazon, Microsoft, Alphabet, the parent company of Google. When that inflation print hit, you looked at the pre-market activity. My eyes were on Amazon in particular, dropping like a stone in pre-market in reaction to that. Going into this earnings season, I think you and I discussed this last week, right? We're bracing for what is just a key earnings season. Earnings expectations in this sector have come down and they're zeroed in on the consumer. This is the test. It's not just about what the Fed does with rates in line with the recession that we expect. It's how the consumer reacts and the readout we get from these companies. Amazon's a really interesting one, right? The third-party data tells us that Prime Day is going well. You see sales growth from Prime Day, which is a 2-day event currently ongoing, that could be in a region of 15 to 30%, depending on which third-party data you trust the most. Morgan Stanley and Brian Novak out with a note this morning saying that actually 2023, we could see top-line growth for Amazon accelerate and profit because they've done a lot of work around fulfillment, right? They're sensitive to the price swings we've seen in fuel, diesel, for example, as well as the inflation story. But this is what we're zeroed into, the language around there. And you showed a slide a moment ago. We have seen price targets cut on a number of these mega cap names that I watch every single day, either being the biggest points gainers or points laggards, and big swings because we're concerned that actually these guys won't hold up as well as they have done coming out of the pandemic.
Ed, thank you. Ed Ludlow there, highlighting Alphabet there as well. This is the line from Google and the CEO as they slow hiring. You need to show more hunger than we've shown on sunnier days. It's the latest from Google. More guidance from Delta. This is what Ed Bastian had to say. We've got to do everything we can, and we have been, to ensure that we serve the demand and serve the quality of the operation and not try to grow beyond our means, which is tempting to do when you see the level of demand. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Well, Delta's down about 7% in the first few minutes of trading. The issue really being that profit missed expectations. Earnings per share coming in about 20 cents below the average analyst estimate at $1.44. And the issue here really is elevated costs. Everything from fuel to labor, just higher operating costs in general that these airlines are facing as it extends constraints on flying capacity. It says it will continue to do so for the rest of the year. The issue, as you allude to, John, is on the supply side, not on the demand side. And Bastian saying that in the last couple of months, they've seen a seismic shift in demand and that they are not seeing signs yet of a pullback in travel spending in the face of higher inflation and a slowing economy. So they still are able to exercise some of that pricing power, which is why revenue for the third quarter guidance actually exceeded expectations. And remember, in that CPI data, airfares were up 34% year on year, even if they were down slightly month on month. So really it comes down to that pricing power issue. It's kind of an echo of what we've seen in earlier results this week, like Pepsi yesterday, in which revenue growth actually outpaced volume growth because pricing was up 12%. And consumers largely for Pepsi seem to tolerate that. So a few positive signals out there that they're still willing to spend. And on that note on spending, you can see that evident in credit card and debit card spending data out of Bank of America. In June, up 11% on a year-on-year basis. That report was released last week, in which Bank of America pointed out that spending on services like travel and entertainment is still boosted by pent-up demand, even as the share of card spending on gas hit 9.8%, John.
Kelly Lyons, thank you very much. Trying to stay on top of a lot here. Euro dollar with a brief break of parity. Just briefly, right now it's above that level. You will hear from central bankers, and when you ask them about the FX market, they will tell you they don't target foreign exchange. But ultimately, the FX channel is important for price stability. That's the way they talk about it. This is what we're hearing from the ECB right now. We are attentive to the impact of the exchange rate on inflation. The ECB does not target a particular exchange rate, but we are attentive to the impact of the exchange rate on inflation. That's the latest from the ECB. Otherwise translated as, we don't want a weak euro right now because that is exacerbating the inflation story. The problem they've got at the moment, though, you've got to ask yourself this: how relevant is the rate story to foreign exchange in Europe right now? When I speak to a lot of FX strategists right now, and they tell me perhaps the most important thing next week is not what happens with the ECB, it's what happens with Nord Stream 1. And that's the difficulty this ECB has and why many people believe President Lagarde is stuck between a rock and a hard place. Euro-dollar right now just above parity. That's the European economy. Let's talk about the American one. Mike Gapen over at Bank of America now writing this. We now forecast a mild recession in the US economy this year and expect 4Q real GDP in 22 to decline 1.4%, a moderate downturn this year, and below trend growth for much of next year, pushing the unemployment rate 1 percentage point higher from 3.6% currently to 4.6%. I'm pleased to say that the head of US economics over at Bank of America, Michael Gapen, joins us right now. Mike, fantastic to see you in a new seat, but we've got to talk about this data before we sit on that topic for too long. So let's do that right now. Your response to inflation from an hour ago.
Well, I think it gives you the indication, certainly, that domestic price pressures are still quite strong and quite robust. So there's been a narrative, as you know, in recent days and weeks that energy prices are moving lower. That should provide some relief to U.S. consumers. That is indeed true. But I think today's report tells you underneath that are still inflationary pressures that are very strong. And we think the Fed will look at the labor market data and the inflation data and conclude it needs to keep moving at a rapid clip. So the price data today is not very comforting for us from the perspective of how easy will it be for consumers to keep up spending in an environment where inflation is elevated.
There's two ways of looking at it, though. You could sit here and say this is the last really bad number, or you could say it's the early signs that this is getting stickier. If you had to take a side on that debate right now, Mike, which one would you pick?
Well, I think we're in the latter camp where we think inflation will be a little more stickier, certainly at the core level, the underlying level. Yes, energy prices are moving lower. It should give at least some help for consumers in the coming months. But we do see evidence that household spending and domestic demand is slowing as we get into the end of the second quarter. We're actually forecasting a decline in GDP now for the second quarter. So we're seeing some evidence and momentum, and there is this trade-off between what is the spot data telling you the economy is still quite strong and robust, spending is still fairly elevated, but trends from our perspective are becoming more worrisome.
Mike, can you talk to me about this growth call then? You touched on it there, and we started the segment with it. What's the character of this recession? Give me the detail. Is this the technical definition of a recession, 2 consecutive GDP declines, or is this going to be the MBER definition of a recession, one that's accompanied perhaps with a labour market breakdown too?
Yeah, I think that at present, would I say that we're in a recession now? No, and I don't think, yes, by the technical standard it would be. I don't think the NBER would conclude that. Our story is more about, say, an NBER-defined recession later this year, probably more along the lines of Q4. It would just be an idea that it'll be difficult for services spending to hold up in an environment where inflation is strong and as persistent as it is. It means the Fed still has more work to do, and you could see at least a temporary break in hiring later this year. It is not a deep downturn from our perspective. It's just the idea that you're going to need a little more pain in the domestic economy to bring inflation down over time. So I'd say if it's an NBER story, and when do we get to that kind of recession? Later this year. We don't think we're there now.
So, Mike, that pain that you mentioned includes a 1 percentage point climb in the unemployment rate. That's in your forecast. I had a question earlier this morning from someone smarter than me about that forecast. And they basically asked, given the participation rate right now, and given where it is and how low it is, how much damage to employment would need to happen to get unemployment up a full percentage point?
Yeah, I mean, so I think the argument here, just in the broader context, is it's very unusual for the unemployment rate to simply rise a few tenths of a percent. When it typically goes a full percentage point or more. So we're talking about employment slowing down and being negative, say, for 3 or 4 months or 3 months or so later this year. But then average rates of employment growth, that would be more in the 100 to 150,000 range over the next year. So compared to where we are currently, that's a big drop off. But that would be consistent more with, a normal rate of employment growth at the late stage of the cycle.
Mike, I can say this. Honestly, fantastic to catch up with you. Just brilliant. And Bank of America are lucky to have you with you. The head of US economics there, Michael Gapen of BofA, who we're going to be catching up with a lot over the next couple of months, I'm happy to say. Your equity market's down about 8 or 9/10% on the S&P. On the NASDAQ, it's down by 1.2. We're coming off the lows here. Looking at the bond market, yields still up about 12 basis points at the front end. The 2-year 3 17. Evan Brown of UBS has a different take of things. This is what he has to say. A soft landing is certainly achievable, but the path to get there may feature a sharp deceleration in the data that makes it difficult for market participants to distinguish between a benign endgame and a recession. Evan joins us right now. Evan, walk me through what all of this means for this market, for you and the team.
Yeah, so markets, in the end, sequencing matters, right? And so we have the destination, which a very good chance it could be a recession. Very good chance still that it can be a soft landing. I mean, there's still solid household balance sheets. There's still China stimulating. We're coming from a decent starting point, a very strong starting point from housing and manufacturing, which is decelerating. But again, the underlying starting points matter. But just this path is going to be really difficult for markets to trade, because you are seeing this slowing data, even if it's coming from a decent starting point. And this inflation print, it's a problem, right? So it's a problem for the Fed. It's going to be very difficult to get off 75 basis point hikes as long as inflation is not durably coming down. And look, tightening policy into slowing growth is just not a good combo for risk assets.
With that in mind, Evan, and I know it's not your base case, you don't see a recession necessarily. What you do see, though, is a market that's going to keep pricing it in. Do we do that more through the equity side of the story? Do you push that through credit a little bit more? Are you expecting the yield curve to take on a different shape, perhaps even be even more inverted? Where are you pushing that view through?
Yeah, I think, and we are cross-asset, so we're looking for the best risk-reward opportunities. But I think equity is still the cleanest play for a negative view, so being underweight or short equities here, because that way you're getting both the pressure of the tightening and the slowing growth. Fixed income is a little trickier. What's happening with the curve. Certainly, it looks like a flattener, but we could get that slowing growth really taking hold as well. And so fixed income's trickier here. I think in credit, there's room for more widening, but when we look out, credit is becoming more attractive, and you pay a lot of carry to be negative on high yield, for example, here. So equities, we think, is the better play at this point.
We'll keep building on that equity story with you. Evan, you're going to be sticking with us. Evan Brown there of UBS. Your equity market down 1% on the S&P. Coming up, bank earnings kicking off tomorrow.
There's going to be, like we've seen in the past couple of earnings seasons, some positives and some risks.
That conversation up next. 25 minutes in, equities off the lows just about. We're down 0.8% on the S&P, call it 0.9 lower. On the Nasdaq 100, we're down about 1 full percentage point. That's the price action. Here's your trading diary. President Biden arriving in Jerusalem later this morning. Big bank earnings kicking off on Thursday with JPMorgan and Morgan Stanley, plus US PPI and another round of jobless claims. Fed speak through the week. Bostic and Bullard on deck later this week. And finally, President Biden heads to Saudi Arabia, followed by UMich consumer sentiment and US retail sales to end the week. Citi just published. The base case is still 75 basis points at the end of this month from this Fed. They say, though, we cannot rule out the possibility of a larger 100 basis point hike or additional 75 basis point hikes beyond this month. A lot to think about. Another big inflation surprise. Thank you for sharing this moment with us. This was the countdown to the open. This is Bloomberg.